Hello, I'm Tara Weber. Welcome to Market Call. Today on the show, we have Andrew Moffs. He's the Senior Vice President and Portfolio Manager at Vision Capital, and he's going to be taking your questions today on real estate stocks. So get those questions in. That phone number, 1-855-326-6266, and you can also send an email to marketcall@bnnbloomberg.ca. Welcome to the show, Andrew. I guess I want to start off with the fact we have seen so much volatility in the market. How does this impact some of the publicly traded real estate equities?
Certainly. I mean, there certainly is a wall of worry out there. Yet what we find at Vision is we can look to the private markets to really understand what's going on with real estate specifically. And though the public markets have priced in a lot of this risk, what is so interesting to us is that when we look at the private markets, both on the operational side as well as on the pricing side, in those sectors where there is pricing power, fundamentals and pricing are still robust. I mean, even yesterday, CBRE put out data of their cap rate survey across Canada, and in nearly every single sector, cap rates are lower in Canada in real estate. And what does that mean? A cap rate is the going-in yield for real estate. The lower the cap rate, the higher the value. It's like a bond. It's the inverse of a multiple. So again, when we look at the private markets, we're still seeing strong fundamentals, strong pricing. The public markets are pricing in a bit of worry, and this type of arbitrage is exactly the type of market that we like to take advantage of.
Interesting. Okay, so U.S. REITs have been outperforming the Canadian ones, so you expect we will see a catch-up soon?
Well, we do. I'll give you an example. For quite some time, and many times coming on this show, we've been very positive on industrial warehouse REITs, frankly, globally. When we look down south in the United States, and we've seen earnings results come out from a majority of the U.S. industrial warehouse REITs, those earnings have been quite strong. We're seeing leasing rates 20% higher, mark to market, meaning the gap between in-place rents and market rents, 60% higher. We've seen a nice outperformance from those industrial warehouse REITs. We seek to see the same thing here in Canada when we see the likes of Summit Industrial REIT report results, for example, in what is really one of the tightest markets in North America where they have a base, which is Toronto and Montreal.
Yeah, and what about, how does Vancouver play into that as well? Because they have pretty high real estate prices.
Indeed. Just like in any business, it's all about supply and demand. And Vancouver is a supply-constrained market, frankly, across every property type. So where you see demand, and you see it in industrial, you see it in multifamily rental, even somewhat on the office side, you're seeing a lot of strength in the Vancouver markets. Unfortunately, through the public markets, we don't have a lot of exposure to the Vancouver market, and so there isn't always a great read-through to take advantage of that strength.
Oh, that makes sense. Okay, that of course is Andrew Moffs. He's taking your questions today on real estate stocks. Get those questions in. That phone number, 1-855-326-6266. And you can also send your question by email to marketcall@bnnbloomberg.ca. Welcome back to Market Call. Today on the show, we have Andrew Moffs. He's with Vision Capital, taking your questions on real estate stocks. And we have an email for you here right away, Andrew. This is from Linda. She says, BSR has done extremely well over the past year, and I'm wondering if it's still a good REIT to hold, or if there's another you would suggest at this time.
Yep, so BSR REIT is definitely a good REIT to hold. We think it is a buy. It's one of the larger holdings in our fund. This is a REIT that focuses on multifamily apartments in the United States with a focus on Texas, in the U.S. Sunbelt, where there's tremendous population growth and job growth. And BSR specifically focuses on that affordable part of the market, which is exactly where you want to be in this part of the cycle. What we like about this stock is that it owns U.S. real estate, yet it trades on the TSX. Thus, there's always seems to be a discount when this happens, that U.S. investors typically don't buy the real estate on the Toronto Stock Exchange. Canadian investors don't typically appreciate the value of the real estate they own in the United States. And what this is translated to is a stock that trades at what we estimate an 18% discount to its intrinsic value or its net asset value. So I feel very comfortable owning this stock. We see a lot of growth ahead and a really great management team.
Oh, interesting question, Linda. We have another email here. This is from Tammy, and she says, do you see value and strong growth in European residential REITs, so ERE?
That's a great question because I see both. It is a value stock, yet it has a great growth profile. ERE is a stock that we own. It is focused on the Netherlands, multifamily apartments in the Netherlands, which is subject to a rent control regime, as well as they have liberalized apartments. What we like about the Netherlands, it's a highly populous environment. There's a lot of population growth, good job growth, and very defensive. This stock trades at a healthy 10, 12% discount to its net asset value. And what is very unique about their business model, which is unlike most any other real estate company, is that in this period of rising inflation, where it's a positive on the revenue side as rents go up, you also have to deal with higher costs. What's unique about European residential is they do not have exposure on the expense side. All those costs are directly passed on to the tenant. So I actually like this stock a lot because you're actually seeing margin expansion in a period of rising inflation, and that's something that's unique on the multifamily side globally. So this is a stock I'd continue to own.
And what expenses are we talking about that are passed on directly to the tenants?
Well, you know what? It's actually that they bear them themselves. It's not even so much passed on. For example, here in Canada or in the United States, it's the property owner that has to pay for the landscaping, whether it's clearing snow, whether it's cutting the grass. In the Netherlands, none of that exists. The building owners don't have to do anything around the property. It's all covered by the tenant in the property. That's just one example.
Oh, you know what? I actually have a friend who lives in France, and she rented an unfurnished, and it came without a kitchen. So yeah, is that kind of what you mean? It's just so different in general.
Isn't it amazing? You have to bring your own floors with you in Europe typically, and that's exactly what ERE is providing, these types of flats. So, and when you leave, you have to leave it in the condition that you came in. So there's typically low turnover and a very stable environment, and this is the perfect type of yield vehicle for those seeking that.
Interesting. Okay, let's get to the phone lines. Let's head first to Stephen in Calgary. Go ahead, Stephen.
Yes, hi there, Tara. First-rate show. Andrew, I wanted to get your thoughts on InterRent. It's really corrected since the beginning of the year. At this price point, do you see attractive value and growth? Many thanks.
I do. InterRent is a multifamily REIT predominantly focused here in Ontario as well as in Quebec. We've expanded out to British Columbia. Great operating team, great management, has always traded at a healthy premium, yet in this market is actually hitting 52-week lows. And I think this is a great opportunity to be buying this stock. And so what is the reason? The reason is more macro. The reason is a lot of investors are concerned about the political risk in multifamily apartments in Canada. The federal government has come out and has questioned large landlords and REITs in terms of what they call rent evictions, in terms of raising the rents and trying to stifle new supply. That is ironically the worst thing you can do for affordability is reduce supply and reduce the incentives to build apartments. All that said, it's provided a lot of uncertainty in the public markets. But again, what I said at the outset of the show, it's the private markets that we focus on. And what is so interesting to us is that values continue to go higher in the multifamily space in the private markets, yet the public markets, they're on sale. So this disconnect, for those that are willing to tolerate some risk, is something that investors should be looking at and taking advantage of. We think InterRent is well positioned, especially as population growth continues here in Canada, especially as immigration continues. All those people coming to Canada are looking for affordable units to rent, and that is exactly something that InterRent provides. So I think you can tell we're pretty bullish on the stock, and is a name we'd be looking to add at these levels.
Okay, let's get in one more. We have Jacques in London, Ontario. Go ahead with your question for Andrew.
Hey, Andrew. Really love when you come on the show. Quick question for you. One of your previous top picks was Storage Vault Canada, SVI. The SVI management team recently extended their expertise into the industrial warehouse space with Parkit Enterprise, PKT. Is PKT on your radar, and what are your thoughts on that new industrial space?
Yeah, so from a macro sense, we're bullish on industrial warehouse. We like the focus in Toronto. That's where a lot of Parkit's assets are currently, but they're looking to expand there. We certainly like the management team, as you alluded to. Storage Vault is one of our holdings in our fund, and Steve Scott is the CEO of that company, as well as the the majority owner in Parkit. Parkit's a show me story. It's quite small right now. It's in its nascent stage. So that could be an opportunity for those looking to put some capital in something that is really a show me story. I think I have a lot of confidence in their ability to grow. What they like to do is find assets to purchase and then vend in from their private company assets alongside those third-party vendors. And that's a nice runway for growth. That's what people are looking for in this environment, is how can I grow the enterprise? And so I think Parkit provides you with somewhat of that story. It's a little expensive just relative to the assets it owns today. So really what you're doing when you purchase a stock like Parkit is you're saying, here's a bet on the management team. Here's a bet on the growth story. It's almost like I'm buying in-place value today with a warrant on an option to the upside. So definitely on our radar screen and looking for attractive entry points.
Perfect. That, of course, is Andrew Moffs with Vision Capital. He's taking your questions today on real estate stocks. Keep them coming in. That phone number, 1-855-326-6266. And we'll see you right after the break. Welcome back to Market Call. Today on the show, we have Andrew Moffs, Senior Vice President and Portfolio Manager with Vision Capital, taking your questions on real estate stocks, and we'll head right back to the phone lines. And now we have Walter in Hamilton with a question. Go ahead, Walter.
Good afternoon. About 3 years ago, the CEO of Brookfield Asset Management wanted to get his share price, or he said he would get it up to $100 within 5 years. However, the share price seems to oscillate around $70, 10% up, 10% down. Was $100 a pipe dream? Is $70 fair value? And would you buy it today at $65? Thank you.
So Brookfield Asset Management is one of the world's premier asset managers. They and Blackstone really lead in terms of capital being put out globally and investing in our space, in the real estate space. Brookfield Asset Management focuses on other sectors as well, of course, general private equity, renewable power, infrastructure, et cetera. I would never bet against Bruce Flatt, the CEO of Brookfield Asset Management. I don't have a crystal ball. I can't tell you if the stock's going to $100, but the upside downside scenario in Brookfield always seems to tilt to the upside. That said, historically, it is difficult. There's a headwind typically to asset managers in an environment of rising rates. Spread investing becomes a little more difficult. Deals become a little tougher to close. But the flip side is it presents many opportunities. I'd be very tactical in finding spots to buy Brookfield Asset Management. I think the company has a lot of ways to create value, and I'm always looking at different entry points. I could be patient today. Like I said, in this type of environment, I've noticed just historically over the past 20 years following these stocks that there is volatility, and you can always find better entry points. And what I would always point people to is Brookfield does a great investor day every September, and you can go back to their presentation where they provide you a bit of a runway of where they are headed and how they intend to get there. And what you can do as an investor is follow along on a quarterly basis how they are tracking against their 2, 3, 5 year goals.
Okay, some good advice there. Let's get back to the phone lines, and we have Peter in Vancouver. Go ahead, Peter.
Hi, good morning, Tara. Always smiling, always make us happy. And the REIT guru, you really have vision on REIT. Please, may I have your expert opinion on Minto? It seems to have taken a dive lately. Your expert opinion, please. Thank you, Guru.
Thanks, Peter.
Thanks, Peter. My comments on Minto are going to be very similar to my comments previously on InterRent. Minto is an apartment landlord across Canada, and quite frankly, just suffering from the same fundamentals that InterRent is suffering from. And again, that's that macro lens of investors concerned about, the strike of the pen risk, so to speak. Whether it's federally across Canada or provincially, we're going to have an election in Ontario and in Quebec this year. What will that mean for rent controls in those provinces? Will they take away vacancy decontrol? Those are all the question marks that are out there that investors are worried about. And so what investors are doing is saying, you know what, I don't want to underwrite this. I'm looking to go invest my capital elsewhere. And whenever these opportunities arise, these are great opportunities to take advantage of. I just talked about Brookfield Asset Management and Blackstone in my previous comments. There is a wall of capital sitting on the sidelines to invest in real estate. We've seen Blackstone in the past couple of weeks buy 2 publicly traded REITs in the United States to take advantage of the discount in the public markets. When I see it in a company like Minto, I'm not suggesting that it's a takeout. I'm suggesting that there's value in the private markets, but the public markets are not underwriting. And I think the risk reward is to your favor in a REIT like Minto today. I see return of demand in their properties, and what will typically be the ability to raise rents on turnover, and that gap, that mark to market and rents should increase, and Minto should be primed to take advantage of it while it trades at a pretty wide discount to net asset value. I think that's a great setup.
Okay, let's get one more, and we have Andre in Chilliwack. Go ahead, Andre.
Oh yeah, quick, Tara, one more call before commercial. Andrew Moffs, I want to thank you very much for Tricon. It was a great stock. Kind of surprised you haven't mentioned much on the macro in regards to rising U.S. interest rates and the economy slowing. It's sure putting a damper on this sector. I'd like to buy more, but I'm kind of lying on the side. Could you give me your thoughts on Tricon and where you see it going? Thank you very much.
Sure. So Tricon has been a stock, I think you can tell we were very bullish on, have been bullish on. Great management team, great sector. And so for those other viewers, Tricon operates in the single-family rental sector in the United States, providing affordable housing really across the U.S. Sunbelt in single-family homes. The dream of owning a home is not attainable to many, and here's the ability to have your own home, have a backyard, have a barbecue, be in a great school district, and have the flexibility of being a renter from a premier homeowner provider. Tricon has done really well. The stock has done very well. And that has coincided. They went public in the United States with an IPO, so it trades on both the TSX as well as the New York Stock Exchange, and really has brought in its investor base and trades now on par with its publicly traded peers, Invitation Homes and American Homes for Rent. All that said, we're still very positive on the sector. The discount is not as wide as it used to be in Tricon. So if you've owned it, perhaps you've taken some off the table, and yet you sit here today and there still is a discount to net asset value and a nice growth profile ahead. So yes, there are headwinds in the economy, but again, if I'm focused on those residents that can afford to pay the rent in that affordable sector, in those segments of the market where there's population growth, so growing demand, no new supply, I think you're good in any type of business, and I think that sets up well for Tricon's single-family rental business.
Perfect. Well, as Andre knew, we have to go to a break now. So Andrew Moffs is taking your questions today on real estate stocks. But right after the break, we're going to go to his past picks. So stay tuned. Welcome back to Market Call. Andrew Moffs of Vision Capital is on the show today, and now it's time for his past picks. So Andrew, these were your picks as of March 30th, 2021. First up, we have Canadian Apartment Properties REIT. At the time, $53.94, now $50.72. So we have a total loss here of about 3%.
Yes. So Canadian Apartment REIT actually hit a high of $62 over the summer and fall, and it's only recently that the pullback has occurred. So we did take advantage of that strength to lighten our position, and we were concerned about the federal budget coming out, and it was actually an opportunity to exit, because we saw what was a growing investor concern over what would happen in terms of future rent controls and this whole idea of rent evictions, which we think will hopefully, so long as continues to be a good dialogue between multifamily owners and government, hopefully it will not be directed specifically to apartment landlords, publicly traded apartment landlords, and they'll hopefully come up with a productive way of managing affordability across Canada. And I think really what that should focus on is new supply. All that said, when you look at Canadian Apartment REIT today, here's a stock trading at call it 15, 20%, 17.5% is actually what we estimate a discount to net asset value. I think that's quite cheap. I think there's an opportunity for Canadian Apartment REIT themselves to buy their stock. They could sell assets and buy their stocks and create a lot of value. So this should be on the radar screen for your viewers to be buying at these levels.
Okay, some good advice there. Now the next one. Chartwell Retirement Residences. I have a family member in Chartwell. At the time, $11.73, now $12.44. So a total return on this name coming in at about 12%.
Yeah, so we viewed Chartwell as a value stock a year ago. Certainly, pre-pandemic, we would have said, here, there's a great dynamic here. There's a great demand setup. We call it the silver tsunami in terms of the aging boomer population requiring this type of great service. Chartwell provides a really great service in terms of the retirement residences and that they own. Prior to the pandemic, the big issue was, hey, there's too much supply in certain of these markets. We're not seeing the rent growth that we'd like to see. Fast forward, pandemic was obviously very difficult for this business. We've now seen a stabilization in occupancy, and now it's a show me story. That silver tsunami has only gotten older, only needs this product more. And the silver lining of the pandemic is that it's really shut down new construction. So when I look at the seniors housing space, I look and I see a lot of value. If they can get back to those occupancy levels of 90% that they used to operate at prior to the pandemic, there's several dollars of upside in this stock. That said, there's still a lot of risk. We haven't seen the move-in, move-out activity work in Chartwell's favor because we've gone through the winter time where you don't see that activity. The spring season will be the first normalized season for Chartwell in quite some time, and we're hoping to see move-in activity. So all that said, it's a stock worth looking at today in your portfolios, and we continue to have exposure to this stock today.
Okay, and this last name performed very well, Storage Vault Canada. Then $4.57, now $6.65. So a total return on this name came in at 46%.
Yeah, this was certainly a good pick. Still a stock that we continue to own in our funds. We really like the self-storage space, particularly in Canada, where there is not as much self-storage space per capita than there is in the United States. Storage Vault is the market leader. This is a business where you need to be the market leader. You can outprice your competition if you have scale, and Storage Vault has scale. This is a business that's very recession resilient. So if you have a view that we're going into a tougher economic environment, here's a business, the self-storage space, that really doesn't get hurt in that type of environment because it really is predicated on life events that happen irrespective of where we are in the economic cycle, whether it's death, divorce, dislocation, disaster. Any of those Ds will occur in any type of economic cycle. People need to store their stuff, and I find we all have a lot of stuff. So Storage Vault continues to trade at a discount to net asset value, particularly as you look at their growth profile in the years ahead. And so it's a stock we continue to own.
We all do have too much stuff. All right, that of course is Andrew Moffs, Senior Vice President and Portfolio Manager with Vision Capital. Stick with us. We'll be taking more of your calls after the break. That phone number, 1-855-326-6266. Welcome back to Market Call. Andrew Moffs of Vision Capital is taking your questions on real estate stocks, and we'll get right back to the phone lines now. And we have Glenn in Collingwood, Ontario. Go ahead, Glenn.
Hey, good afternoon. Andrew, Morguard Corp hasn't done anything for years. It doesn't pay much of a distribution, but it does reinvest and or buybacks any free cash flow. Supposedly, replacement cost is materially lower. What is your current opinion? I'll listen to your call. Thank you.
Yeah, so Morguard Corp, you're correct. It's not a REIT, so it does not need to pay out its cash flow. I think you meant to say replacement cost is much higher, and we would agree. This trades at a very, very wide discount to its net asset value. Some of it is justified. The asset classes it's invested in, whether it be retail and office, are not the sectors, and when I say retail, I mean enclosed malls, are not typically the sectors that investors are looking to allocate more capital to today. But they do have great exposure to multifamily, both here in Canada as well as in the United States, and some exposure to industrial. They also have exposure to hotels as well as some other businesses. The knock on the company is that typically investors might say it's a value trap. They don't pay out any cash, and what's going to happen? What's going to be the catalyst? What we would say to that is, sometimes the capital allocation decisions make a lot of sense. Buying back stock is the way to go if you're trading at such a deep discount to net asset value. Allocating capital to other sectors where there isn't a great supply-demand dynamic may not be the right way to go. And so I think there's been a bull-bear debate in Morguard for quite some time. What we find is, these discounts don't persist forever. That said, this one's persisted for quite some time. If they were operating in a better investing environment for some of the assets that I mentioned, retail and office, I'd say this is probably the right time to step in. That said, they are not, but the discount is quite wide. So if you own it, it's probably a safe hold at this point, given you have so much buffer to the downside, but you might see better growth elsewhere in different sectors.
Okay. Let's go to Teraver in Phoenix, Arizona. Go ahead, Teraver.
Yes, my question is on Public Storage, PSA stock symbol. Mr. Moffs, you had previously said that they were less than their asset value. Is that still the case because the price has gone up? And their dividend hasn't really increased in the sense it's $1.5 billion for the last 4 or 5 years. Is that a good or bad sign? Thank you.
So two good questions there. First, Public Storage, which is the largest self-storage provider in the United States, 60-70 billion market cap, just to give you a sense. They today trade at a premium to net asset value. The stock has rallied considerably from where I probably talked about it previously, when they were subject to some activism from some large shareholders. I do like some of the capital allocation decisions they have pursued recently, and the most recent one was the announcement this week where one of their subsidiaries, a public company, PS Business Parks, which owned industrial warehouse space, where they owned a majority interest, that company is being acquired by Blackstone. All that said, Public Storage trades at a premium in a great space and has done very well. What does that typically translate to for a dividend-paying stock is that you'd expect the dividend to be quite low if the stock has done well. I don't view the dividend high, low, medium as an indicator of anything, quite frankly. What matters more is, A, can the REIT pay that dividend? Do they have sustainable cash flow to pay it? And Public Storage certainly does. And B, quite honestly, I like the idea of capital retention, to just simply pay out the minimum required by tax laws and then retain the rest of that cash flow to be put to work. And in real estate, you have to appreciate, you have to reinvest that capital. You have annual minimum maintenance capital expenditure requirements that you have to put into your assets, even in an industry like self-storage. You have to, whether it's improving the driveways, the lights, the fixturing, elevators, et cetera, the roof, you have to maintain capital. But more importantly, you also want to invest in growth. You want to buy new assets, especially for a company like Public Storage that has scale. So I like the idea of a low dividend because then they retain the cash flow to invest both internally, maintain their assets, as well as for external growth.
Okay, let's get in Anita from Toronto. Anita, what's your question for Andrew?
Hi, Andrew. I just wanted to know how you see high interest rates impacting REIT valuations.
It's a great question, and there's no single answer. What do I mean by that? I can tell you that in periods of really high interest rates, you can find great opportunities to buy buildings. I can tell you in periods of very low interest rates, you can find value traps and terrible ideas to buy real estate. So I'll give an example. You could have a very low interest rate environment, a booming economy, and yet you would not want to buy an office building in Calgary, Alberta, Canada, because there's way too much supply, there's no demand, and vacancies are 30%. So what does this all translate into? It's all about supply and demand, like any business. There's too much focus when it comes to real estate on interest rates. But why is there the focus? Because the valuation equation for real estate is the net operating income, so your rents, less your expenses, divided by what I've talked about before, the cap rate, the going in yield. That cap rate is influenced by interest rates for sure, but there's a spread to it. We can't do anything about the denominator. We can only focus on the numerator, the rents. So your best hedge in a rising rate environment is to buy those sectors, invest in REITs in those sectors where income is going to be increasing, where those REITs can capture inflation. Because if interest rates are going up because of inflation, that's a good thing. So think about apartments. Your rents reset every month. Think about self-storage, same thing, every month. Industrial warehouse every 3, 4, 5 years. You're going to capture inflation. So what you're hopefully going to see, if there's pricing power in the markets that you operate, you're going to see that numerator increase faster than the impact of interest rates. I certainly wouldn't want to be invested in office buildings today in a rising rate environment. That you are getting squeezed on both ends. You do want to make sure that the REITs that you invest in have the cost of capital, that their debt is fixed, that they don't have too much exposure to floating rate interest, because again, as rates go higher, it's going to be more expensive. So those are the elements I would think about. I wouldn't be too focused on is it right or wrong to invest in REITs in a rising rate environment, because I can show you many studies where REITs generally outperform in rising rate environments.
Okay. And of course, I'm in downtown Calgary with that big downtown office vacancy rate. But that, of course, is Andrew Moffs, Senior Vice President and Portfolio Manager with Vision Capital. He's taking your questions on real estate stocks. Stay with us. That phone number, 1-855-326-6266. Welcome back to Market Call. Andrew Moffs of Vision Capital taking your questions today on North American real estate stocks, or international as well. Next up, we have Vasil from St. Laurent. Go ahead, Vasil.
Hi, Andrew. My question is about U.S. home builders. They're all basically plumbing 52-week lows at a time when, while the U.S. housing shortage is not called a crisis, apparently there is a shortage of homes, and they seem to have pricing power, and they're earning record profits, but the stock prices are way down. So I'm wondering, is it just the fear of higher interest rates that's forward-looking, creating these opportunities? And I'd like your thoughts on that, and if you were to pick one, Lennar, Pulte, Meritage, which one do you like? Thanks.
Yeah, it's a great question, very timely question. We talk about it almost daily internally. It's somewhat like catching a falling knife. If you thought it was a value, if you thought there was value in U.S. home builders 3 weeks ago, it looked more attractive 2 weeks ago, looked even better a week ago, and it's even better today. At the same time, I think you're exactly right. These stocks trade below book value, at book value, and they're producing 30% ROEs. That is a great setup. And why is that? You're exactly right. There is a housing shortage in the United States. And really more specifically, there's a housing shortage in the areas where there needs to be housing. Yes, you can build homes in certain parts of the country, but those are not the parts of the country where people are moving to. There's great business models across many of the U.S. home builders. The easy thing to do is to buy the iShares, the ITB index, ETF, for example. That's a great way. You don't have to make a big bet on one or the other. I like the business model at D.R. Horton, ticker DHI. I like the business model at Lennar, ticker LEN. Even some of the smaller cap builders, Century Communities, Taylor Morrison, I think you can find value in any one of these. You're really fighting the macro. When you have mortgage rates at 10, 15-year highs, that's not a great setup from a sentiment perspective. That said, so long as these builders can continue to sell homes and these homes continue to be affordable, people can still qualify at those mortgage rates, you have great earnings power. So there will be a day where the market will turn. And so I said, it's like catching a falling knife. I just can't, I don't have that crystal ball to tell you today's the day. But certainly the risk reward looks in your favor buying home builders here.
Okay, let's get to Anita in Markham, Ontario. Go ahead, Anita.
Good afternoon. Thank you for taking my call. My question is on Granite REIT. And my question is twofold, Andrew. Number one, I own a bit of CT Rate, Summit Industrial, and Chartwell. Would Granite be a good combination to go with it, or what would your recommendation be? My total exposure to real estate in my portfolio is about 7 to 8%. Number two is in an environment where the interest rate is going up now, should I invest more into real estate at all? So I'll hang up and listen to you. Thank you so much.
Yeah, thank you for that detail. Well, first, I can be specific on Granite REIT. I like Granite REIT. We own the stock in our fund. It's operating in a great space. That's the industrial warehouse space. It operates in Canada, the United States, and Europe. If you're considering adding it to your portfolio, where I do see it being additive, whereas unlike Summit, which you mentioned you own, Granite has that exposure to Europe. And at any point in time, I think today is the day that you want to have growing exposure in industrial in Europe. Certainly, I'm not blind to the fact that there's political risk in Europe. There's recession risk in Europe. That said, warehouse space is doing quite well. Industrial warehouse is many years behind the United States and Canada and Europe in terms of, the read-through. If you look at e-commerce as percent of retail sales is much lower in the Netherlands, in Germany, et cetera. And as you go all the way down through all the France, Poland, et cetera, and that is only increasing, and the pandemic has really sped that up. There's now a rush to get warehouse space across Europe, and Granite provides you with a neat exposure to that. I think they have about $2 billion of property in Europe. So I like the stock. It trades at a discount to NAV, and you can take advantage of those fundamentals. A rising rate environment, should you be increasing your allocation to real estate? I did talk quite a bit about this earlier in terms of I can find reasons why with interest rates going higher, you should buy real estate. I could tell you if interest rates going higher, you shouldn't. And it's all about the economy, what's going on behind the scenes, what's going on in the markets you're investing in, and specifically what sector you're invested in. I'm a very bottom-up investor, and I care about buying stocks at a discount to NAV, and I have a longer-term view. So if I'm willing to buy something with a 2, 3, 5-year outlook and hold it and get nice income along the way, I think you're not going to go too far off. A lot of these names are very defensive, very value-oriented. I like some of the names you mentioned that you own today.
What a great question to end on. That, of course, is Andrew Moffs, Senior Vice President and Portfolio Manager with Vision Capital. You're going to want to stay tuned. His top picks are coming up right after the break. There. But first, let's get to Andrew Moff and his top picks. So, Andrew, your first one here is Boardwalk REIT. Now, I know from being here in Alberta that we're starting to see real estate pick up. Is that a big part of what's behind this top pick?
Absolutely. You have a tailwind for Boardwalk with 37% of its apartment suites in Edmonton and 17% in Calgary. You're talking about a province that doesn't have rent control, and that's been the big overhang across Canada in the multifamily landlords as to why they have all underperformed, with the exception of Boardwalk. Boardwalk is free to move its rents. Of course, it's operated in a more difficult environment recently, and so now we have this tailwind where there's a clear line of sight in net operating income growth. And what is that? It's the fact that concessions are going to burn off over the next 1.5, 2 years. And by that alone, we estimate that the value of this REIT should go up $10, $15. We see, when we look at the private markets, we see a couple things. We see, as you pointed to, strengthening fundamentals. Occupancy is up. Their apartments are full. You're now starting to see pricing power in rent. That's what I mean by concessions burning away. You don't have to give as many incentives for people to move into your apartments today. But more importantly, we're looking at the private markets, and we see really incredible pricing for apartments in the private markets today in Alberta specifically. Recently in March, we saw a portfolio about $140 million trade at a cap rate that is far lower than the implied cap rate of Boardwalk today. So when we look at this stock, it's a stock trading at a big discount to net asset value, a nice runway to growth, a solid management team, and we think this is a great stock to be buying here today.
What a turnaround. I even remember 5 years ago, apartments were offering a free month's rent or a new TV if you were to move in and just sign that lease. So yeah, it's a big change. Let's get to your next one here. We have Sun Communities. Why did you choose this one?
So Sun Communities is a much more defensive residential operator. They operate in the United States and in Ontario, Canada, in the manufactured housing communities space, as well as the RV space. They've recently entered the marinas space. So in all of this, you're finding value housing as well as value leisure opportunities that attract the drive-to market across the United States. This stock, because it is so defensive, has always traded at a premium to net asset value. This year has presented us with an opportunity that's only happened a few other times recently, where it trades at a discount to net asset value, and we have taken the opportunity to establish a large position in our fund in Sun Communities. Why? Because it's defensive. People typically move their manufactured house onto these communities. They pay the land rent. They're responsible for all the costs. The landlord has minimal capex, and they're not going to be moving anytime soon. Rental increases are manageable. We're talking about very low land rent, so the percentage increase might sound high, but the dollar amount spent is not as high. We really like the move into the marina business. It has a very interesting supply-demand, almost barrier to entry. Very similar to manufactured housing, where people typically don't want to build any new communities in their backyard. So all this sets up to a defensive housing play on the United States that trades at a discount to NAV, that historically always trades at a premium. It's a setup I really like today.
Is there growth in the marina space? Is this people who actually just want to live on their boats in a marina?
No, these are more high-end yachts that typically need to be stored somewhere. There's a limited amount of slips across the United States, and with that comes tremendous pricing power. There's been a lot of wealth creation, and a lot of toys have been purchased, and they need to be parked somewhere, and Sun Communities is providing that service, as well as the ancillary revenues that come with, quote, docking your boat at any one of their slips.
Yeah, yacht's a little out of my purview. Okay, let's go to the last one here. We have Summit Industrial Income REIT. Why did you choose this one?
Yeah, so I've talked around Summit throughout this broadcast. Summit is the best way to play one of the strongest markets, or perhaps the strongest market in North America, the Toronto industrial market, and secondarily the Montreal industrial market. These are very tight. When I say tight, I mean 99% occupied markets, and you're seeing rents 20, 30% mark to market in rents. All that translates into property values that are probably 60% higher than they were prior to the pandemic. The Summit management team has a track record of creating a lot of value. They had a Summit One, we like to call it, their first go around as a publicly traded REIT, was sold in the 2000s. We can see this eventually being a perfect platform for the likes of a Blackstone to come in and purchase this entity. I'm not suggesting it's happening tomorrow or anytime soon, but I'm just saying here's a portfolio that someone could buy in bulk, trading at a discount on the public markets. Whereas if you wanted to buy a warehouse today in the Toronto or Montreal or Vancouver markets, you would have to pay a hefty premium to buy that one asset. I can buy a huge portfolio today with a platform at a discount. We think it trades at a very wide discount to net asset value, and I think it's a great opportunity to be buying Summit today.
Okay, well, thank you so much for your thoughts today. That, of course, is Andrew Moffs, Senior Vice President and Portfolio Manager with Vision Capital, sharing his thoughts on real estate stocks for this entire hour.